Hi there, everyone. I am Lens Beniskayobit, one of the accounts executive at Principles. So for today's video, we are going to discuss the great principles in valuation. There are six key principles under valuation. The first one is the value of a business is defined only at a specific point in time, meaning that the business value tend to change every day as transactions happen. Different circumstances that occur only on a daily basis affects earnings, cash position, working capital, and market conditions. Valuation made a year ago may not hold true and not reflect the prevailing firm value today. As a result, it is important to give perspective to users of the informations that firm value is based on a specific date. Next is value varies based on the ability of business to generate future cash flows, meaning general concepts for most valuation techniques put emphasis on future cash flows except for some circumstances where value can be better derived from asset liquidation. The relevant item for valuation is the potential of the business to generate value in the firm, which is in the form of cash flows. Future cash flows can be projected based on historical results, considering future events that may improve or reduce cash flows. Cash flows is more relevant in valuation as compared to accounting profits, as shareholders are more interested in receiving cash at the end of the day. Cash flows include cash generated from operations and reductions that are related to capital investments, working capital, and taxes. Cash flows will depend on the estimates of future performance of the business and strategies in place to support this growth. Historical information can provide be a good starting point when projecting future cash flow. The third assumption is market dictates the appropriate rate of return for investor. What does it mean? It means that the market forces are constantly changing and they normally provide guidance of what rate of return should investors expect rather from different investment vehicles in the market. Interaction of market forces may differ based on type of industry and general economic conditions. Understanding the rate of return dictated by the market is important for investor so they can capture the right discount rate to be used for valuation. This can influence their decision to buy or sell an investment. The fourth one is the firm value can be impacted by underlying net tangible assets, meaning that business valuation principles look at the relationship between the operational value of an entity and net tangible of its asset. Theoretically, firms with higher underlying net tangible asset value are more stable and results in higher going concern value. This is the result of presence of more assets that can be used as security during financing acquisitions or even liquidation proceedings in case bankruptcy occurs. Presence of sufficient net tangible asset can also support the forecast on future operation plans of the business. Second to the last and the fifth one, value is influenced by transferability of future cash flows, meaning transferability of future cash flows is also important, especially to potential acquirers. Business with good value can operate even without owner intervention. It affirms survival depends on an owner's influence. This value might be transferred to the buyer, hence, this will reduce the firm value. In such cases, value will only be limited to net tangible assets that can be transferred to the buyer. And last principle is value is impacted by liquidity. This principle is mainly dictated by the theory of demand and supply. If there are many potential buyers with less acquisition targets, value of a target firms may rise since the buyers will express more interest to buy the business. Sellers should be able to attract and negotiate potential purchases to maximize value they can realize from the transaction. And that's the key principles in valuation. Thank you guys for listening. See you on the next video.